Hi, this is Sean Johnston from Centric Wealth Advisory. This is another video which I'm going to go through a template that has been created to just make life easier for anyone wanting to switch between a US dollar investment or South African rands. It is a simpler template to the one I've previously shared where it pulls exchange rates. And the reason for that is because it does not require an external link to a website which pulls the exchange rates and updates it accordingly in the Excel spreadsheet. I'm going to do a quick share screen now to show you what this template is all about. This template is purely for educational purposes, as per the disclaimer, but the idea behind the template is to take an investment and either calculate the future value of the investment with or without drawing in income and factoring in escalations of that income when you're doing your planning. So what I'm going to do now is I'm just going to take a very basic investment. Let's say it's 2 million Rand. There's no investment drawdown. 10% is the compounding growth rate. And essentially, if it's a Rand investment and you want to see what the future value is in Rands, it's going to report in Rands. However, if you've got a US dollar investment, obviously you would put the fund value of that investment when you do the switch, but you click the button and it'll perform a macro, which is basically a pre-recorded step which changes the currencies to the US dollar. I have put 2 decimals just for accuracy, but the principle behind this simply is we want to see the future values of this investment, and you can obviously decide which currency you want to track it in. And the reason why this template is useful is because you can factor in a few scenarios when you're doing your planning. This is obviously voluntary money. There is no restrictions with the annual drawdown, which obviously leaves risk for capital depletion, which is why this template is quite useful. But if you invest in 2 million Rand and you compound it at 10%, you can see what the compound growth is. This is the balance at the end of the year, which carries into the following year. And then, of course, you can factor in the fees, etc. I have left it off for now, but if you were to put in a tax rate and just say maximum is 45%, it'll then pull through the tax rate. It's irrelevant now because you're not drawing an income. So let's say you've got 2 million Rand and you go and draw 20,000 per month. Like obviously that's proportionate. So obviously 20,000 relative to 2 million. In this case, it's a 12% drawdown. That's with getting the growth. Obviously, if you had no growth, it's 14 years with the 10%, and without, it's 8. So obviously getting return your money is important, but of course, obviously, if you're drawing down an income that is too high relative to the growth, so 12% is higher than 10, your money's going to start depleting. And as time goes by, because you are increasing your, you are continually drawing an income, and as your funds reducing, it's reducing further, to the point where it fully depletes in around 14 years. Only alternative if you're in this position is to get a higher return, but in reality, it's not going to make a massive difference if you are drawing an income and hoping to have it last 20, 25, 30 years. So the solution really would be draw something less, work on a lesser growth rate, be a bit more realistic, not factor in fees, but let's just say we put in 1% ongoing. Then obviously your investment would, so you can see here with investment is 26 years in fees, and without, it'll not run out. So obviously fees are important because you need to invest on a platform. You have your asset management fees, administration fees, there's ongoing advisory fees, and a lot of people might question why there's advisory fees, but of course the advisory fee is quite important because to achieve a 10% return, your portfolio has to be reviewed every year to see your asset class diversification, but also looking at other aspects that might change in your life. So you do have to increase your drawdown to 18,000. Then your investment return needs to be 12%. You need to take more risk, and it's all relative. Of course, as I've just shown you now, on 10% return, your money is going to run out in 19 years. If you were able to achieve 12%, your money would not last 42 years based on the calculation, even though you're taking 18,000 and not 15,000. So this is where a financial planner can play a very vital role, because their job is to grow your money and also assist with providing the income you require, and hoping with intent to have it last as long as possible. Now, of course, obviously, the buying power of money, as I've shown in the previous video, is not factored in. So in other words, the income that you're drawing down, which in this case is 216,000 or 18,000 before tax, that is not adjusting with inflation. So 10 years, 216,000 will not have the same buying power. In the previous videos, I've shown that using the rule of 72, if you take 72 divided by inflation, or 6%, the money will halve in 12 years. So 216,000, that would become 108,000 in terms of buying power if you were to look at it in today's terms, which is not ideal. Of course, obviously, it'll do so further when you're doing further drawdowns and not escalating that. In other words, if you look at 20 years, 24 years rather, then this would have halved even further, which is not great. So now if we factor in, let's say 6%, this is where it gets really tricky, because now if you're increasing your drawdowns at 6% per year, one really needs to look at what is the income that I'm going to be drawing from this. Obviously, it depends on the person's circumstances. If they're comfortable with the money potentially lasting only 16 years, then that's fine. But trying to get a higher return, let's say this is 14%, it's not going to make a huge difference in terms of longevity of the capital, but even 12% is pushing into a more aggressive asset class mix, which is really at the risk of the investor if there's a downturn in the market and they still need to draw an income. So really realistically, you maybe want to take a lesser amount, and that money will then last longer, working on, let's say, 12%. If you want to be a bit more conservative, 10%, you still have to factor in fees. So it might be 12% plus the 1% ongoing. So the point is, you can play around with different scenarios to see which is the best mix, especially if you are trying to advise a client and he says the client comes to you and wants you to put together the best possible strategy. If he's got 2 million rand, he wants to draw an income from it. How long is it going to last? Factoring escalations, potential growth. It is a linear return. There are models that do non-linear. It works out different types of scenarios. But the reality is, any forward projection is an assumption. We cannot guarantee returns are going to achieve the same values every year. This is an average. So you might get above 12%. You might get below 12%. You're most likely going to be looking at offshore component and drawing from that and converted it into rands. That also is an element one needs to look at. And that's why having a financial planner can add a lot of value, because if a client is looking to invest and they do it incorrectly, let's just say they're going to take 13,000 and they're only, they invest and they put in something that gives you an 8% return. They're going to deplete their funds a lot quicker, 13 years. Had they not, if they'd gone to an advisor and, looked at their investment currently and say, well, if we change your assets and put you into a bit more offshore exposure, we could probably push you up to 10%. That could make a 2-year difference. It obviously depends on the client's circumstances and what they're looking at. But 45%, which is the maximum tax rates. Obviously, when you're drawing your income and you declare tax to ZARs or whichever reporting institution, which country, let's say you're paying tax abroad, then of course you would apply the tax rate. But I'm just working on average at 45, which is the maximum in South Africa. If you want to rather look at let's say a person's got a dollar investment and obviously it doesn't convert. It doesn't take 2 million divided by the exchange rate. I'm just working on 2 million. Let's say it's got a fund balance of $2 million, and you were to draw $13,000 from that, it'll do exactly the same calculation. It won't do any conversions. But it's just if a client has got a dollar investment and he wants to see the drawdown in dollars, then you can just use this graph to illustrate the same thing. Use no, as I said, no exchange rates. It's not going to take 2 million divided by the exchange rate to give you a lower amount. Then obviously they'll need to adjust the 13,000 because it's in dollars. We're just assuming this person has $2 million as an investment, and he wants or she wants you to do the calculation to determine, well, if I draw $13,000 and I'm looking to increase that by, okay, let's make it 4%, and I get a 10% return in my investment, and ongoing fees is 1%. Your money is expected to last 18 years. Obviously, it's an assumption, and having annual reviews is quite important. I'm not factoring upfront. Let's say there was a 0.5 upfront. That would then deduct off the starting balance to get you to that, and that will then have the amount drawn off. And this is the amount before and after tax. Obviously, I am using the highest tax rate just as an example, but the point is that you can play around with different scenarios. There's explanation at the bottom. So I've just said here, based on $1.9 million invested with initial income of $13,000 per month, which is escalated 4% per year. Capital invested will deplete in 18 years if the growth rate is 10% compound. Any value change, we'll update accordingly in the explanation. Some formulas built in to do that. And if we get to a stage now, let's say you're drawing 8,000, 55 years, it will tell you 55 years, but let's say you're going to put in 4,000 and your money never depletes. It's going to actually say it'll never deplete because your annual drawdown relative to the growth is a lot lower, which means that you're drawing 2.4%, getting 10% growth. Over time, your money is compounding. Your actual drawdown will start to reduce. This is a scenario where a person has got money, wants to draw a small amount, doesn't need a lot of it, has got other investments elsewhere, and they want to just do a calculation to see what the impact would be. In other words, they want to grow their money, but they also want to take a bit of it to live off or use it for expenses, put it towards maybe property to settle debt and property, but also not deplete the funds. You can use this template to do that. And these calculations, just the time value of money over there, just do a separate formula. But the point I'm making is that you can either do it in US dollars or rands. I find this template to be quite useful if a person's got a lump sum and it's voluntary money, which means there's no restrictions in the drawdowns, and they want to just do a few scenarios. This template comes in very handy versus you trying to now do this manually on a calculator when you've got to factor in so many variables, upfront fees, ongoing. And what's also nice is you can see it per year. You can actually see the breakdown, starting balance, the income drawn off, the tax before and after. You can see what the ongoing fee is, the capital remaining, and then the growth added to that, and then the balance carries into the next year. This is how a calculation would be done if you were working on a software program. Exactly the same thing would happen. This is the back end. I'm just making the back end visible so you can actually physically see how the money can deplete potentially. So if again, put this back onto, let's say 8,000, obviously it's not going to deplete until 55 years, which is great. But if you said to the client, well, let's make it 9,000, what will happen if I make it 9,000 at 37 years? Okay, again, obviously very low, but as soon as you start putting in 12,000, then you'll start to see when it actually fully depletes. In this case, obviously in 21 years, not bad, obviously depending on the client's age and their circumstances. But in 20 years from now, based on 12,000 escalating to 4% at an anticipated growth rate of 10% compounded annually, this is what the cash will look like. And this might be the decision the client makes, or the client says, you know what, make it 11. So currently it's 20 years. Make it 11,000, 24. So you get another 3 years. But again, the client might decide to take a lower amount initially, increase it later on, depending on investment returns. And this is again where financial advisors are very important because they do annual reviews to assess your portfolio, asset classes that you are invested in, how are they performing, and they make recommendations if you need to do any switches, etc. later down the line. You can't just go into investment and hope for the best over the next 10, 20 years. There always has to be a review to see what's going on because there are so many different factors one needs to look at with different various asset classes. Some asset classes outperform, some asset classes underperform, and it's important to get the right mix so that you're in the right asset class when it is performing and not in the wrong asset class when it's underperforming because you're going to maximize your returns. And the only way to do that is to have a strategy, but also speak to a financial planner to explain the best possible investment strategy for you so that you can achieve these outcomes. But this is purely for educational purposes, for you just to learn more about depletion of capital, growing your funds. If you don't take a drawdown, obviously, as I've shown you before, the tax is not relevant and the escalation is not relevant, but you can see the future values. So it's just a future value calculator. It saves you having to go and manually put this into a calculator and do it that way, or to physically write it down to see what the compound return would be. But I'm also factoring fees. So now I have to take the 10 minus 1, there's your fees, and also the upfront. So it adds more elements to it when you have to do this manually. Anyway, thank you so much for taking the time to go through this video with me. I guess before, you're welcome to download the template and use it yourself. It is in the description. You would have seen it when you saw this video for the first time. Hopefully you downloaded it and gone through the template with me. But there's something you can save and keep for future reference, even just for educational purposes. If you're doing exams and you want to know if I've got a lump sum, and I want to work out a future value over a period of 30 years or whatever, you can use this template to calculate that and factor in fees and upfronts if you want to. Thanks for now. Hope to make a future video that we can go through more templates that we have got available to share with you. But we do hope this adds value to your learning experience as you go through these videos with us. Thanks for now. Hope to create another video soon. John.